Welcome to your 2018 Benefits Open Enrollment. We encourage you to spend some time reviewing the options available to you. Lakefield Veterinary Group and Best Friends Pet Hotel are proud to provide you and your family with a comprehensive benefit package, and we hope you find this presentation informative. During the presentation, we will answer 7 commonly asked questions and provide you with some tips to maximize your benefits along the way. Let's look at the changes for 2018. As you may know, you have 2 health plans from which to choose. One is a high-deductible health plan that includes a tax-advantaged health savings account known as an HSA. We've made some great enhancements to this plan for 2018. The health plan will now cover 80% of your medical expenses after you meet your annual calendar year deductible. This means your portion of the costs, also known as co-insurance, will be 20% instead of 30%. Of course, once you meet your annual out-of-pocket maximum expense, the health plan will pay 100% of your medical costs for all in-network services. As medical costs continue to increase, we also found it necessary to make some changes to the traditional PPO plan. Copays have been adjusted upward for office visits, hospital stays, and emergency room visits. The out-of-pocket maximum, or most you pay for in-network medical costs, is the same regardless of the health plan you select. All other benefits remain unchanged. Remember, open enrollment is your one opportunity each year to reassess your coverage needs and make changes to your elections for the upcoming plan year. During this window, you can switch plans, add or drop dependents from your coverage, and enroll or re-enroll in the flexible spending account. All 2018 elections must be made by December 10, 2017, and will take effect on January 1, 2018. Each year, we thoroughly evaluate our benefits offering. We look at not only our healthcare benefits, but all of our benefits, and we consider carefully how our plans are structured. Please make sure that you review the details of each medical plan option this year to determine which one is right for you and your family. Let's take a look at the 2 medical plan options. First, you have the high-deductible health plan that includes the tax-advantaged health savings account known as an HSA. In 2018, Best Friends Lakefield will contribute $700 into your HSA to help you offset your deductible and out-of-pocket expenses. These contributions are made tax-free on your behalf. You may also contribute pre-tax money out of your paycheck. The total contribution amount the IRS allows, including the $700, is $3,450 for an individual, or $6,900 if you have at least one other family member on your health plan. The HSA is a bank account in your name. Any unused funds will roll forward for your future medical, dental, and vision needs. Although this plan has a higher deductible, the premiums you pay out of your paycheck are lower. The second plan alternative is a traditional PPO plan. There is a lower deductible, and you pay co-payments associated with your doctor visits and prescription medications. This plan costs more out of your paycheck, so be sure to review the 2 options closely, as it could net to higher costs for you depending on your medical needs. Let's take a look at a side-by-side comparison of the plan features. The traditional PPO plan has an individual deductible of $500 per family member, up to $1,000 maximum if you have dependents enrolled. The out-of-pocket maximum, which is the maximum cost before the plan will pay 100% for in-network services, is $6,000 per family member. It's capped at $12,000 if you have additional dependents enrolled. This plan has co-payments of $25 for primary care and $40 for specialists. For hospital visits, you pay a $250 co-payment per day to a maximum of $1,250. Then the plan covers at 80%. Preventive care is covered at 100%. For outpatient surgery, you pay a $100 copay and the plan will cover at 80% after you've met your deductible. You also have a $150 copayment for emergency room visits. Now let's compare that to the high deductible health plan with the health savings account. With this plan, you have a $1,500 deductible. With 1 or more additional family members on the plan, this becomes what we call an aggregate deductible of $3,000. That full deductible must be met before the coinsurance will start paying for the coverage. Note that it is not capped on a per-person basis. For this plan, the deductible must be met prior to any payments from the insurance other than for your preventive care. Preventive services are covered at 100% regardless of the plan you select. Once you meet the deductible for the high deductible health plan, your insurance will kick in at 80% and you pay 20% of the cost. All payments you make out of pocket will accumulate toward your out-of-pocket maximum, including the costs of prescriptions. Your out-of-pocket or maximum expense is the same regardless of which plan you select. For the traditional PPO, there is a $40 copayment for your urgent care. It will save you a lot of money if you seek care at an urgent care facility versus going to the emergency room when you feel your need is not serious. Durable medical equipment and rehab services are covered at 80% after you meet your annual deductible. For the high deductible health plan, again, all coverage is 80% after you meet your annual deductible. Both of these plans are considered PPO plans in that you may self-select your physicians within the United Healthcare network. If you choose an out-of-network physician, you will pay more out of your pocket, as shown on this slide. Also, those physicians have the right to charge more since they are not under contract with United Healthcare. Please be sure to search for doctors and facilities that are in the network in order to save money. You will pay the lowest amount for your generic medications. Generic does not mean lesser value. It simply means that those medications are no longer under patent. Competition brings the pricing down for all of us. There is a $10 copayment for generic medications, but often you will pay less as many of the large retailers only charge $3 or $4 for these medications. For a preferred brand, you will pay 25% of the cost of the medication with a $25 minimum and a $50 maximum for a 30-day supply. For the non-preferred brand name, you will pay 25% of the cost with a $45 minimum and a $90 maximum for the same 30-day supply. Please note, if you're on the high deductible health plan, these copays come into play after you meet your annual deductible. You may also choose to enroll in the mail order program if you're taking consistent medications. With the mail order, you pay a $10 copay for a 90-day supply for your generic medications. For your preferred and non-preferred, you are charged 2 times the copay instead of 3 times the copay for a 90-day supply. So you basically get 1 month free. Also remember, all of your copayments and deductibles accumulate toward your out-of-pocket maximum, and although most people never spend enough to hit their out-of-pocket maximum, it does happen. Once you meet that, all of your in-network medical and prescription claims will be covered in full. Some of your preventive medications will be covered at 100%, no deductible or out-of-pocket cost to you. So if you're looking to take a new preventive medication, be sure to look on that list and see if you can get your medication free. This slide is meant to give you a visual of the two plans. Note that although your deductible is higher on the high deductible health plan, you do have $700 over the plan year to help you offset that cost. You also save $1,258 during the calendar year in premiums that you pay out of your paycheck. Together, the premium savings and the $700 employer contribution equal more than your deductible. The out-of-pocket maximum is the same for each plan at $6,000. The cost advantage will typically go to the high deductible health plan, although some people like the predictability of the copayments on the traditional plan and prefer to pay more out of their paycheck in order to have the richer plan design. If you have family members on the plan, pay great attention to the premium savings to enroll in the high deductible health plan. For a family, employee, spouse, child, and or children, the savings is $3,731. This is money, real money that is taken out of your paycheck to cover your family. If you could put this money into your health savings account for future use or to offset your costs, it could be very beneficial. You will want to look at the two plan options and take time to determine which is best for you and your family based on your personal needs and prior medical plan utilization. The premiums associated with your healthcare are very costly. We understand that. We pay a majority of your healthcare premiums. When you look at the plan cost for premium and the potential maximum out-of-pocket expenses based on your medical and prescription drug claims, you can see that that number becomes very large. Again, most of us will never hit that out-of-pocket maximum, but it does happen, so we want to be sure you understand the risk. The PPO plan is very expensive. When comparing each category and considering the $700 we provide into your health savings account, you will want to be sure to make the best choice. Certainly, the maximum costs are much greater when you are enrolled in the traditional PPO. Again, if you are able to contribute some of that money into your HSA versus enrolling in the more costly PPO plan, you may come out ahead. Before you enroll in the high-deductible health plan with the tax-advantaged health savings account, let's talk a little bit more about how it works. By now, you may have an idea of which medical plan you prefer to enroll in. If you are undecided, this may help. You might prefer to pay less out of your paycheck and understand the need to pay deductible before most of your needs are covered by the insurance, and you like the idea of saving into a bank account for current and future healthcare needs. Or you don't mind paying more out of your paycheck to have a lower deductible and more predictable co-payments throughout the year. Let's talk about how you qualify for those HSA contributions. There are a few rules which are set by the IRS. First, you have to be enrolled in the high-deductible health plan, as it meets the requirements of the IRS. The IRS designed this health plan because there is a tax advantage to having the HSA. They state that as long as you are enrolled in this type of health plan, you can open and contribute to an HSA. If later you are not enrolled in a high-deductible health plan, you can still use your HSA funds on any of your medical, vision, and prescription drug expenses for you and your legal dependents. It's always your money to use. However, you may not put new money into your HSA unless you continue to be enrolled in a high-deductible health plan that meets the needs or the IRS requirements. Essentially, the deductible applies to everything but preventive care. In addition, you can't have any other dual coverage that is not considered high-deductible health plan, such as your spouse's plan or VA coverage or Medicare. You also can't be claimed as a dependent on somebody else's tax return. Here are some reminders about our high-deductible health plan. All eligible expenses, even prescriptions, count towards your deductible. Just like our other medical plan, preventive care is free when you visit an in-network provider. Getting your annual checkups can help identify any health risks early on so you can take steps to be healthier. Even if you haven't met your deductible, you can save money by using in-network providers because there are limits on what they can charge you for your services. It pays to shop around to find the lowest cost prescriptions or cost of services. Another way to save money is to talk with your providers about the cost of services before you receive them. Some providers will work with you on the cost when they know you are paying out of pocket. Lastly, the IRS has a list of approved HSA expenses. Please be sure to review it to ensure that you don't have to pay any penalties for using your HSA on non-eligible expenses. For those of you who are coming into this plan for the first time, you must open an account for the HSA by the 31st of January 2018 in order to receive your HSA contributions. The company contributes, and you may also contribute to your HSA. Contributions to your account are federally tax-free, and interest or investment earnings within the HSA grow tax-free. As long as you're using the funds in your HSA to pay for your qualified health expenses, any distributions are also tax-free. Qualified health expenses include your deductible, coinsurance, co-payments, costs for prescriptions, dental and vision, also premiums like COBRA premiums, long-term care insurance premiums, and Medicare premiums into retirement. If you take a distribution for a non-qualified expense, you will owe income tax on the distribution, plus a 20% penalty if you are under the age of 65. Beyond the age of 65, you can use the money for any purpose. However, if you use it for a non-medical reason, then you will pay ordinary income tax, but you will not have the big 20% penalty on that money. It's your responsibility to keep those receipts, so remember, keep them in a file or somehow scan them so that if the IRS were to audit you, that you would be able to support any distributions that you've taken. This account will stay with you even if you leave the company because it's yours. The plan works exactly the same for families. However, the IRS does allow you to contribute more to your account on a pre-tax basis, similar to a 401k, if you are able to do so. While the high deductible health plan gives you more flexibility to manage your own healthcare costs, you also have a few paperwork responsibilities. Make sure you're using your account only for qualified healthcare expenses so you don't get hit with that 20% tax penalty. You'll also want to save your receipts just in case you need to provide copies to the IRS. Note that if you contribute to an HSA or use funds from an HSA account, you'll need to file a regular tax form, not the 1040EZ. This is because one extra form will need to be filed. Remember to get your preventive services. They are very important to your health and covered in full for you. Preventive includes many things, including your annual visit to get your numbers checked, your pap smear, mammograms, colonoscopies, and more. Please be sure to check free preventive care on the United Healthcare website to determine if you will be covered in full. The chart shown here reflects your 2018 premium costs for medical. These are shown on a per pay period basis based on the plan selection and coverage level. Let's talk about the other great benefits we provide on your behalf. In addition to our medical plans, you have access to dental and vision benefits as well. The dental plan has not changed. You have a $50 deductible per family member capped at $150 total. Your annual plan maximum is $1,500 per member, and preventive care is covered at 100%. Basic services are covered at 80%, and major services are covered at 50%. We always recommend you get a pre-treatment estimate for major services so that you can work with your dentist. Major services can be quite costly, and it's difficult to understand how much they are typically until you get the bill. We also cover orthodontist services at 50% to a maximum of $1,500 per lifetime. To find your dentist, visit the Delta Dental website or contact your provider and ask if they are in the network. You may visit any out-of-network providers as well, but please understand that it could cost you more out of your pocket since they are not under contract to lower their rates. The vision plan is through VSP. You pay $10 for an office visit and $25 for your hardware. If you use contact lenses, the plan covers these up to $130 per year in lieu of lenses and frames. Frames are covered up to $130 or $150 for featured frames at VSP. You also receive discounts on any additional costs. If you go out of the VSP network, you may seek reimbursement for your costs by filing your claims to VSP. There is a capped amount as shown on this slide, depending on the service you've received. You may find your VSP providers by visiting VSP.com or again, contact your provider to see if they participate in the network. There are no ID cards associated with the VSP plan. You simply tell your provider that you are with VSP and they will find you in the network. This slide exhibits the payroll costs for your dental and vision coverage. In addition to the core benefits, the company provides life and accidental death and dismemberment coverage on your behalf. Your coverage is 1 times your annual earnings up to $20,000. These benefits reduce at age 65, and conversion is available in the event that you leave the organization. There is a voluntary life benefit available to you if you choose to enroll in additional coverage. You can get increments of $10,000 up to the lesser of 5 times your earnings or $300,000, with a guaranteed amount of $100,000. The guaranteed amount only comes into play if you are newly eligible for this plan. Your spouse can get increments of $5,000 up to the lesser of 50% of the employee amount or $30,000. Children have coverage as well, dependent on your enrollment. Our healthcare FSA allows you to set aside up to $2,650 in pre-tax money for paying for things like medical copays, prescriptions, and other out-of-pocket expenses, as well as dental and vision expenses. You may only enroll in this if you are enrolled in the traditional PPO plan. If you are enrolled in the high deductible health plan, you will want to put your funds into a health savings account. The health savings account is not use it or lose it. The flexible spending account is use it or lose it. You may roll over up to $500 in unused funds into the new year if you're enrolled in this plan, but otherwise you may lose funds if you do not spend them or get the reimbursements in time. So please plan very wisely as you enroll in this flexible spending account. You may also set aside up to $5,000 in pre-tax money to use toward daycare expenses if you and your spouse are both working or one is a full-time student. For those of you with kids under 13, you know how expensive daycare can be. Paying no tax on the money you spend can be super helpful. There are two ways to access your funds on your FSA. You will be given a debit card called a Benny card that is preloaded with your annual election amount. Use it at your providers, pharmacy, outpatient centers. Pay your final bill when you get it. Always keep your receipts, though. The IRS heavily governs this program, and you may need to submit receipts in order to ensure that you've spent it on the right things. File a manual claim. You can use out-of-pocket funds and then request reimbursements from your FSA. You can file the claim by fax or by mail. Your spending account services address is here. The fax is 800-595-4642, or you can visit the website at mymarketlink.com to view your claim and check the status. Call with any questions at 800-580-6854. This is a partial list of the qualified expenses. You can search this list online by looking for the IRS publication 502. There are many, many things that FSA dollars and health savings account dollars can be used for reimbursement. So please get to know the list, make sure that you're using the plan wisely. Our EAP is there to help you year-round. You have 24-hour access 365 days a week to counselors for you and your family. If you need to discuss an issue you are going through, or seek help with family or marital counseling, or if you are simply struggling with something personally, you can find help here. You and your household members also get up to 3 face-to-face visits free of charge. It's an extremely confidential service, and we encourage you to get to know it. The EAP can help with many things, including legal issues, finding family and pet care, and financial guidance. If you are interested in our discount program for home and auto insurance, please contact Stephanie Snyder. She will assist you in attaining a quote that could save you hundreds of dollars. Stephanie can be reached at the information above, phone number 253-927-6555, extension 58575. Please note that this presentation is intended to provide you with a general overview of the benefit plan options that are available to you. For more detailed coverage information, you will want to refer to the plan document. If you have questions, certainly please call the Benefit Advocate team or your Human Resource Department. Let's talk about where you can find out more information and how you can get your questions answered. If you still have questions, you are encouraged to reach out to our Benefit Advocate services. The Benefit Advocate team will help you with any needs throughout the year. If you need a new ID card, you don't understand a claims payment, you want to understand how your benefits work in general, or you need to appeal a claims decision, it is important that you seek help. This service is 100% confidential, and it's great to have someone that's sitting on your side when you need assistance. Thank you for participating in the presentation today. We hope you will call if you have any questions.